Today, we're diving into the real battleground of the global EV transition, where China is rewriting the rules. This isn't just a story about cars or price wars. The real power shifts are happening deeper in the supply chain, forces that will come to shape the next decade. With me today is Miranda Cheng, Maybank's Hong Kong equity strategist, and we will be discussing the competitive forces within the chemistry labs, the gigafactories, and the energy storage systems industry. Miranda, so great to have you on today. It's only apt that I start with this first question. While history is never a perfect predictor of the future, there are probably still lessons to be learned from China's automotive successes as well as failures in the internal combustion engine era. What, in your view, are the most important lessons to take away and to also help us better identify patterns and trends in the current electric vehicle era?
Thank you. First, thank you so much for having me. I'm more than happy to share and go deep dive with the latest EV development in China, the automakers, companies' development, and their competitive landscape. So I think that this is a very good question. Why this time is different than the past era? Because back in those days, in the late 90s or early 2000s, the ICE engine era. But this time, we can see that China EVs rise up is quite different than in the past. I can say that we are seeing that China auto learned a lot from the history. In the past, in that auto industry, there's very rapid market entry and very rapid exit of brands. We can see that back in those days, many small ICE OEMs emerged in the late 90s or early 2000, and they're producing cheap automobiles at very cheap prices, and they're producing it very fast. But what happened back then, those companies failed within 5 to 10 years due to lack of scale, lack of technology, and then the overcapacity triggered brutal price wars, forced margin collapse, and forced mergers. So why is it different this time? Because we are also seeing some old problems, right? Some overcapacity problems or price war problems, but this time, I think that is the technology is different, because in the past, the technology lag also led to the dependency of the Chinese ICE OEMs. They relied on foreign JV tech like Volkswagen or General Motors, and their independent R&D was very weak in the past. They are just copying the old styles of cars. But this time, China Auto spent years to achieve self-reliance of the whole auto supply chain, from steel, engines, to battery, to chipsets. So we think that the competitive landscape this time in this new era is different. And in the past, there's no brand loyalty to. In the past, Chinese customers are all eyeing on the price. They only care about the price. But now I think that they also care about quality and also care about the spec. So I think that the whole customer ecosystem is also changed.
So, when you look at the EV industry, and if we consider that we're actually maybe past the adoption phase of the market cycle, it looks like the hypergrowth stage at this moment. Do you think we're still here in the hypergrowth stage?
I think that we are going into in an evolvement, and we are going to consolidation stage. Actually, in China, the EV penetration rate is very high. It's already surpassed 50%. It's like 51%. But there's still room to grow, especially in lower tier cities. In tier 1 cities, EVs adoption rate is very high, but we can still expand to tier 3 and tier 4 cities. Will it be a super high growth? I think that eventually, and China government is also targeting to 80% EV penetration rate. I think that eventually market will consolidate and restructure a lot. The client segmentations and the big EV companies and auto makers, they have to find their way to survive. Maybe some of them are specifying in high-end models, some of them are specifying in entry levels models. We need some more time to observe how the EV companies may consolidate. But I do think that overall, in general, is still a very high growth sector in China. Plus, we are also eyeing on their go global strategy, because Chinese automakers are trying to export many nice EV cars to Europe, to Middle East. So I think that the market is still big, and the growth is projected to be still a very high growth. But I think that inside different tiers of companies or different types of company, the pace would be mixed.
That's an interesting point. To your note about consolidation, what in your view would consolidation look like based on your experience growing up in the ICE era?
Because in the past, there are many companies in China when the ICE eras came. So, but many of them just closed down or failed 5 to 10 years later. And there's some news report also stating that actually, in some time, actually lately they are seeing that there's some numbers of the EV startups already closing down, because in the past few years, the EV industry is growing in very high speed. So many startups are claiming that they are making EV, right? But we cannot see any kind of prototype of that car. So lately, news reports are stating that this kind of EV startup is already closing down. And McKinsey and there's some research institution also projected that by 2030, maybe China's automakers will consolidate into just or maybe 30 or 40 very big companies. There won't be that much player in the market back by then.
And if we look at the market today, how many players are there? There have been many reports in the media, but many are also conflicting in nature.
There are more than hundreds, but there are so many because there are so many different tiers of EV brands and so many different tiers of automobile brands in China. And some of them may be not focusing in tier one cities. Some of them maybe are focusing on maybe even hybrids. Some of them are very entry level kind of brands. There are too many. So I think that it is crucial for us to do an investment outlook for this sector. We have to understand that this is not a sector that the price war is fierce, the competition is fierce, so there's no opportunities in that. No. But we have to analyze it carefully because the complexity is higher than before.
Well, looking at the competitive landscape then, how seriously should we be thinking of the threat from European and Japanese automobile makers? Are they ever a clear and present danger to Chinese dominance in your view? And can they strike back just as hard for their own survivability?
This is also a question that many of us will think or ask. How about the car makers that we used to know, like BMW, Mercedes, or Toyota? Can they fight back? So I think that China may continue to lead. And this is hard for EU and Japanese players to catch up. That's because this is a whole new game now. The technology and quality is starting to win, not copies. Because in this EV era, China owns like 85% of the global battery cells, 98% rare earths, and cheap OTA technology. OTA, that means over the air updates, are doing every 4 to 8 weeks. And there's many small smart apps, log user like iPhone. They are building their own car owner ecosystem too. So I think that China is leading in this EV technology, and they're leading the whole supply chain too. And the supply chain log can let China's cost stay 30% to 50% lower. So I think that China control from mines to cars end to end, and because Europe is depending on imports of rare earths, 89%, and 80% of lithium they imported from China, and Japan imports like 75% materials from China too. So when China's lock up the whole supply chain, we can see that they can make very high efficient and cheap batteries, and they can lower their cost than their rivals, like 50% lower prices, but they can still achieve 20% margins because they are producing everything on their own. They can produce their own chipsets. They can source the best battery manufacturers in China. So I think that the supply chain had already been very mature for now.
What percentage of the EV cost is actually coming from battery components?
That's around 40%. It's a very important component of one EV car. The battery costs almost 40%. And that's also echoing back to your question that, why EU and Japan cannot compete or chase the differences? Because I think that EU and Japan's development already lagged behind too much. They couldn't outpace China brands' import speed because China has 51% pure EV penetration right now. But for Europe, in Europe, only 15.8% BEV share year to date. This is missing EU's CO2 targets too. So the automakers are facing fines. And in Japan, BEV is not a fashion. Hybrid is more fashionable in Japan. So I think that there won't be very strong pure EV capability till 2027.
Well, to your point earlier, it's very interesting to hear from you that it seems like incumbents in any industry can only survive by adopting the challenger's architecture, not by defending the old one. And when you look at this set of challenges, are there any other parallels in history where the incumbent leaders, with the same skill and clout to a country's GDP, fought back successfully given the same set of competition?
Yeah, this is very good questions. I've been doing some homeworks of this kind of industry competitions or emerging industries involvement. Actually, there are some examples that fought back, but those cases are highly dependent on some new innovations. For example, in the past, IBM versus cheap PCs, when IBM ruled the big computers back in 80s to 2000s, but almost died when cheap PCs arrived. So their new CEO changed the whole company from selling computers to selling services and software, and they even sold their PC business to Lenovo. So today IBM makes most money from cloud and AI, not hardware anymore. So the takeaway is they stop doing the old thing, they start doing new higher value thing. And for Apple versus Windows, Apple was almost bankrupt in 1997. And Steve Jobs come back and made beautiful products like iMac, iPod, and iPhone, and built a closed ecosystem. So customers stay loyal, and Apple went from nearly dead to the world's most valuable company. So the takeaway is they think of some very innovative way to sell products. In the past, they are just thinking about the spec. They use great design to hit customers' heart. But in China's EV, this time is quite difficult because China has a very strong grip in every little segment in the whole supply chain of EV. For example, China automakers, they can produce a very nice software in their EV now. Their EV software can directly link to their smartphone. They can use their smartphone to do many upgrades. They can use their smartphone to check many metrics of their EVs, like battery life, like other metrics, and they can also control it. Some of the high end models have control through the smartphone. You can use the parking function of the smartphone. So I think that this time the opponents is not easy to find new angle to win back the game.
If Chinese EV makers are the only lead runners in this race, do you then think it is increasingly more difficult or easier to value an EV OEM?
Yeah, I think that this is a very pinpointed question, and it absolutely is. Because nowadays, when we study into EV era, we need to study into so many technical knowledge more than ever. Because in the past, ICE cycle built on mature global technologies like engines, gearbox, those things evolved but didn't change in 100 years. But the EV cycle is more disruptive. Many new tech involve like battery, motor, inverter, and new business models like software and charging. Is the charging systems cooperating with the EVs? Is there any enough charging stations in one cities? How's the grid integration? So there's a lot more to study, and innovation may cause great impact and is very technical. We because we're not scientists, but we have to closely monitor if any groundbreaking innovation of the battery technology show up in the market that will completely change the game, right? But now the roadmap is clearer. We understand that this company is doing this kind of research. We are also, it's difficult, but it's crucial to keep up to date of the battery development these days.
The media loves very flashy headlines: robotaxi, autonomous driving, etc. Can these technologies be a credible P&L driver for EV OEMs?
I think that robo taxi and like auto driving is still in a very early stage, because when we are looking into this new emerging industry, this is a huge market, but slow profits. China could be the world's biggest robotaxi market by 2030. That's market value close to USD 40 billion plus. But companies may need 5+ years to turn losses into profits. And in China, actually, there are many companies already launching robotaxi. Baidu's Apollo Go, they are providing 250K rides per week. We can see that actually China's customers are willing to try new things. And the regulations are also cooperating with the robotaxi development, because China wants to promote some new innovation or new innovations and new technologies. But I think that the safety rules is not easy to tackle, because robotaxi rides are growing fast, but regulations and safety issues are still a concern, like extreme cases like accidents or weather. Because lately we are seeing that when some accidents occur, that the can quickly hurt the total adoption or the total reputation of the robotaxi or the automated driving landscape. So I think that the trust is still fragile, and need many years to refine the sensors, to refine the insurance system, the fleet systems. Still need many years, and the leaders are still losing money too. Like Baidu's Apollo Go, they're just launching it and doing it, but positioned for very long-term potential. But the robotaxi revenue to Baidu still less than 5% of total. And Pony AI and Rewrite, those are leaders in China, but they are still in loss of the latest reporting. So I think that the market is huge, but maybe we will come back into this area after 3 or 4 years. Yeah.
I presume then, from all you've just mentioned, that the share prices of all of these companies who pay more attention to the AI algorithm side of driving, that their share prices have actually not performed versus the OEM makers. Is that the case, or is that not the case?
This is the case when they are doing the IPOs, and their stock price doesn't perform. Let's say for Pony AI and Rewrite, but lately they announced that the quarter net losses reduced a lot. So maybe the profit roadmap is clearer. So there's some recovery of this sector. But you're right that the stock prices or the sentiments in this sector, I think that will be very volatile.
Right. Okay. And I suppose BYD cannot even escape this cycle. Despite being so strong in terms of vehicle sales, quarterly set of earnings did not prop up the share price.
I think that BYD is still a leader in the industry, and BYD is the number one automobile maker in the world now, and they are expanding into global very quickly. I think that this is crucial for them to see if BYD can grab the market share in Europe, grab the market share in South America or in Middle East. This will be the key metrics, the key indicator to watch. Despite BYD's profit drop like 30% in the latest quarter, it still tops the charts. It's still the number one car sales in China and over the world, number one brand. So I think that the scale is huge, but we have to. But the domestic market is very crowded already. So I think that is very crucial to see if the Go Global strategy works well. And so far, it's developing quite fast.
This may be a broader question. Then, what do you think will ultimately define shareholder value for Chinese EV OEMs in 2026?
I think that margin and volume are both very crucial because in EV sectors lately, people are always mentioning margin. We have to see if any car makers can still giving an increment of their margin, and we are seeing that Xiaopeng and Neo and their margins improved during the price war. That's very great because they roll out high-end models and they roll out very strong software upgrades. But I think that volume scale will become more critical post 2026. As we've mentioned before, there will be many industry consolidation upcoming. And so the price war in China have driven EV prices down 10 to 20% year on year. That's eroding the profitability, even the sales rise. And in China accounted for like around 68% of the world's new energy vehicle market share. In the first 10 months, China's NEV sales reached around 13 million units. units, and the export is increasing very fast. And NEV exports total 2 million units. That's a 90% increase year on year. But we are seeing that, like we mentioned about BYD, is still the boss, still the big boss, but volume cannot translate into sustainable profits. BYD is world number one in terms of BEV, but their Q3 profits dropped 33% to 7.8 billion. But does that mean that, BYD is doomed? I don't think so, because I think the critical part will be the go global strategy. BYD is in a very positive position, because BYD has the whole supply chain in outside China. They have factories in Europe, they have factories in Germany, Hungary, and they are producing their own chipsets through the BYD Electronics. They are producing their own blade battery. So I think that in terms of the supply chain management and the global strategy, BYD is still in a very advanced position. And also, their sales volume will be crucial when the consolidation era is coming.
Let me then ask then, in contrast, are battery makers a better bet?
I totally agree with this observation, actually, because we believe that we have been we have mentioned so many different sectors and so many different aspects in Chinese EV. Is that no growth already, or price war too serious? No one will earn money? No, just that the sector became complicated. And when we are valuing it, when we are analyzing it, we have to very closely watch into different kind of metrics. We have to see near-term, mid-term, and long-term impacts. Maybe some companies suffer near-term, but in long-term, their competition position is very advanced. So, but yes, I think that for us, investment perspective, I totally agree that battery stocks are currently a better bet than automakers, because automakers face very high risks everywhere. Even Chinese brands like BYD, Xiaopeng, Xiaomi, they risk fast customer switches in better or cheaper rivals. So that means one flop of their key model, flagship model, will cost them billions. So this is kind of risky. They have to make sure that they roll out something that will hit. The price wars also crushing their profits, because subsidies is fading fast in China too. China is ending the EV purchase aids since 2022. And I think that battery makers are safer and very profitable for now, because battery makers, they sell to all. They sell to Tesla, Volkswagen, BMW. No matter which company wins, they can also win together. There's no brand loyalty needed, and the demand is also surging very quickly. The global installation from 1 TWh in 2024 to 3 TWh by 2030. This is industry's projections. And also, not only benefit from the EV boom, they are also benefiting from other new technology booms, like data center. They need many batteries, like energy storage system, require very large battery capabilities too. So I think that battery is definitely a better bet for now.
Well, the growth outlook, as you've just put it, seems limitless. But every technology cycle, be it mobile phones, semiconductors, and even the humble television set, is not impervious to disruption. What competencies or technological leadership must battery makers possess to continue delivering performance and minimize switching costs from its clients?
Yeah, this is not easy, but we can use some examples to demonstrate our theory. Well, I think that power batteries, as of the first half of 2025, CATL is also one of our spotlight company. CATL is the supplier of the battery to Tesla, to many domestic brands, to Huawei's EVs. And CATL held like a 38.1% global market share. This is well ahead of BYD's 23%. And CATL has ranked number one worldwide for 8 consecutive years, maintaining leadership in both EV and energy storage batteries. So I think that what makes CATL so powerful, I think that first thing would be the market share, because KL and BYD already grabbed 55% of global EV battery share for now, and KL is huge scale, crushes their cost lower, and it makes it's very tough for rivals to match their costs, because they are grabbing the whole battery supply chain. They source from raw materials, from rare earths. They have their own super factory to do the production. And CATL has a very complete chemistry edge, chemistry roadmap too. They lead in safe and cheap LFP, that's lithium, iron, and phosphate technology. And they are also doing breakthroughs in sodium-ion batteries too. So they are researching into different kinds of batteries to fulfill the customer needs. Maybe some of them want high performance, some of them want high range, but maybe some of them just want some neighborhood car for city commute. So, and CATL's factory power is very strong too. Their vertical chains control 60% lithium processing. So I think that this is very important for battery makers to achieve the above conditions. Otherwise, the competitive landscape would be very tough.
Yeah, I guess this comes back to your earlier point about companies having very tight controls over their supply chain, and whether they're vertically integrated or horizontally integrated, right? So this then becomes a self-reinforcing flywheel, which is why newcomers find it so hard to compete against. Now, in coming back to CATL's latest quarterly earnings again, how should investors analyze the company's chemistry roadmap? And how does this roadmap translate into financial performance as well as a long term competitive advantage for the company?
Yes. So when we are studying EV boom, when we are studying batteries, we have to learn the technology behind this too, because this is crucial when we are doing investment analysis. So chemistry roadmap is a multi-lane highway for CATL. CATL built several parallel paths that include safe and cheap lane, high energy lane, ultra fast charge lane, and long range and future solid or sodium lanes. So they always have the right battery ready as car makers' needs evolve. No single dead end bet. Because I understand that in China, maybe people's requirement for performance and range may not be that high. Because in China, the high-speed railway and the highway network is very advanced already. So maybe there are many needs for neighborhood cars or daily commute cars for city range. So, but I think that the CATL's is doing it in a very smart way. They are rolling out different tiers of batteries to fulfill different EV owners' needs, and I think that this can be projected that they can turn science into cash flow, because each of the new lane I've just mentioned just quickly becomes high volume products that raise profit margins, creating flywheel, more R&D money put into faster innovation, and then it drives bigger market shares, and then it produces even more money. So I think that their chemistry roadmap had already is a very nice closed circuit already.
Could you elaborate a little bit more about the future? I'm actually more interested to learn from you how CATL can actually make high charge batteries, as well as its future line of batteries that are coming up. For example, the Nextra line, which is based on sodium ion. How can CATL make these products mainstream in nature?
Mm. So yeah, I think that it's a very good question because we have to study into the battery technology to understand the outlook of 2026 2027. And I think that CATL had already secured a very clear profit roadmap. In 2026, we think that the high rate LFP leads because CATL rolled out 神行 LFP that adds 400 plus kilometer in 5 to 10 minutes, and it's just costs 80 to $100 a kWh. So this is 20 to 30% cheaper than NMC. NMC is the battery that mainly used in Europe or the Korean battery makers. NMC includes nickel and cobalt, and those are very pricey metals. So CATL's Shenxin LFP will cost lower and safer, no fire risk, and the market share in projected is 60% in China and 44 to 60% global by year end of 2025. And so Tesla and BYD choose it for reliability too. For 2027, we expect some new thing will show. LMFP improves the density. LMFP may come. LMFP means LFP plus the manganese. The density will increase 40 to 20%. And Volkswagen and Volvo are testing it for the EU CO2 rules too. So that expected 10 to 15% share of LMFP, and it's good for mid-size EVs too. So in 2026, 2028, as you have mentioned, there's some even newer technology show up like sodium-ion. But we think that sodium-ion will grow slowly, like CATL or Hiner. They launch 500 kilometer packs at $50 kWh, no rare metals, fit budget EV or storage in India or Africa. But this is very low density batteries, so limits the use. So I think that the market share projects to around 5% by the industry. So I think that CATL has already completed a very clear product and profit roadmap.
Again, keeping on the track of technology roadmap, what does the next gen semi solid technology hold for the world in the future?
Semi-solid batteries is a new topic, and many companies are studying, researching into it. Semi-solid batteries, because nowadays the EV batteries are all liquid, because they are all liquidated raw materials inside batteries. So there's fire dangerous. Semi-solid batteries can store more energy than today's lithium batteries, and giving EVs longer driving range. And of course, it's better safety because with less liquid electrolyte, and the risk of overheating on fire is reduced a lot. And cost advantage is easier to make than full solid state batteries, so mass production could come sooner. But I think that the wider use will not only for EV but also for energy storage, especially aerospace and consumer electronics. So I think that is a huge opportunity in the next generation semi-solid battery technology. But so far, the cost is still very high and under research status. But there's huge opportunity lies behind it.
Okay. So for battery makers, does energy storage systems or ESS become the second engine that smooths out EV cyclicality for many of these battery majors?
Yes, this is also one of the reasons that we think that batteries is a better bet than automakers right now, because ESS can smooth out the EV ups and downs. EV sales can drop suddenly, but energy storage grows steadily, 23 to 27% every year by industry research, and gives battery makers very stable orders, especially when there's strong policy supporting and AI data center centers emerging, there's a very reliable money. Government supports and huge data center demand push ESS sales up fast in China. It's like a 54% growth in early 2025 with higher profits than car batteries. So, and big makers are switching into ESS too, like CATL or their Korean opponents, LG and Samsung, and others are adding hundreds of GWh of ESS capacity to keep factories full and profits high, even when EV sales are slow. AI data center is a huge opportunity sets for the battery makers because AI data center need to run like 24/7. They cannot sustain if any electricity unstable. So ESS may shine in this area.
Could you tell us a little bit about the latest government policy trends? What do latest disclosures tell us about the growth outlook for ESS?
Yes, as we have already looked through the 5-year plan and we have already looked through China's latest technology efficacy, we can see that they are aiming a big push on energy storage system. There's big capacity boost planned by the government. The Chinese government released a 2025 to 2027 action plan to build up energy storage to 180 GW by 2027 and more than double the 74 GW at the end of 24 to support more green power and stable grids. And the fast growth already happening. In 2024, new energy storage at 37 GW and over twice the year before and hitting the old 2025 target early. So the new report shows that a 130% jump in installed capacity, pointing to very strong ongoing expansion too. So I think that the government is very clear that they want to support new innovation. They want to support new disruptive or new emerge industry. So ESS is definitely one of their plans.
From the sounds of it, you like CATL very much. Do you prefer CATL over CNGR?
Because CNGR is a raw material provider for battery companies. Actually, CNGR is also they also supply their raw materials to CATL. But I still believe that CATL leads the pack. And this is the thing when we are understanding the whole EV boom, whole EV supply chain. We have to pick the winner in the whole supply chain. So we think that CATL will lead the pack. CATL is the world's top EV battery maker with about 37% global market share, way ahead of CNGR, which makes battery materials like cathode precursors and has a much smaller role in the full battery chain. And CATL has a very strong money growth. Net profit jumped 41% to 2.6 billion in the latest quarter. They are showing very solid earnings from high end, but CNGR lacks this level of profit power as a supplier because they also suffer the upstream's precious metal price fluctuation. So the CATL also benefit from the big global push. CATL invested like 15.7 billion overseas since 2021 for factories in Europe and Asia. They are teaming up with Tesla and BMW. So CATL is also adopt a very successful go global strategy. They make sure the global supply chain runs smooth and can drive the cost down. So I think that CATL would be a better pick if we like batteries and if we like this area.
Miranda, as a final question, what upside do you gain by buying automakers? For example, BYD for scale, I suppose, Xpeng for software, Xiaomi for perhaps its design and premium models. What do we gain by buying these names at this market cycle? And what risks do you dodge by owning the picks and shovels players like battery players instead?
Yes. So this is a very good questions of the whole perspective because it's not that I don't like the automakers in China right now. I do like them actually. BYD, Xiaomi, Xiaopeng, and Neo. They are rolling out very innovative products. BYD is dominating in entry level cars, dominating in EV bus, EV public transportations, and the global markets. They sell very good numbers in Europe. And Xiaopeng and Neo, they are making high-end EV models, and they can achieve a margin increment in this bad big environment. And Xiaomi's innovation is very good too because they combined everything in their IoT ecosystem. That my smart TV can link with my smart car, can link with my smartphone. So each of them had their competitive edge. But when we are speaking of investment, I think that we have to be very picky. Only buy the strongest player at today's low prices. Focus on giants with huge sales like BYD, Geely, strong overseas sales and stable profits, or top software or AI like Xiaopeng or Xiaomi. So there's a lot more homework we need to do if we really want to invest in automakers. But battery plays, I think that can near term dodge the key risks because there's no direct hit from the 38% EU tariffs on EVs. There's no sales slumps or price wars. Battery supply to all winners, no matter Tesla, Volkswagen, or BYD. Stocks like CATL are stronger and far less chaotic for now, for near term. I think that battery offers safer and fatter profits too. It's like 20% plus margins, and with the ESS growth we've just mentioned, that beats automakers' low single digit margins and subsidy cuts. It's much smoother and less stressful, right? But can we also pick the top automakers? I think that we can, but we have to be careful, like when to enter into this sector, how do we project the recovery roadmap of this sector? Do we need to wait until the consolidation ends, or we position in advance in the huge players, the winners? I think that it will be. So this is so it makes battery for now a safer bet near term over the automakers.
Okay, great. Thank you so much for your insights, Miranda. This is a wrap. Great show. I'm sure the audience will love it.